Right now we've had a little pullback. It's stuck around 4,000. It's consolidating around 4,000, which it seems to be sticking to it like flies stick to fly paper, 4,000. So I think the secular bull will end up peaking out, I think, around $6,000 an ounce.
We're back to the high levels, not quite on gold, but yes, on silver. But neither silver nor gold are as overbought as they were 3 weeks ago. The day of buying and holding bonds is over, and that's why they're recommending half of that bond position be liquidated and put into gold. The only problem with that is if everybody did that, you'd have gold at probably, who knows, $2 million an ounce. Just pick a number, but it's going to be super, super high.
The gold and silver markets continue to draw massive attention as prices show strong resilience despite recent fluctuations. Gold remains steady around the $4,200 mark, consolidating before what many analysts expect to be another breakout, and silver had extended gains to 6.34% as it traded at $54.2 per ounce. With global inflation concerns, currency instability, and central banks increasing their gold reserves, investor confidence in precious metals remains high. Silver, too, is following the bullish momentum, with market sentiment indicating potential for significant upside in the coming months. In this video, we hear from Steve Hanke, a renowned economist and professor, sharing his outlook on the ongoing secular bull market. Hanke believes that gold's long-term rally could ultimately peak around $6,000 per ounce. He discusses the market's current consolidation phase, explaining why short-term pullbacks are normal in a strong upward trend. His insights shed light on why patience and perspective are key for gold and silver investors right now. Let's watch clips from Steve Hanke's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
I think the secular bull will end up peaking out, I think, around $6,000 an ounce. Right now we've had a little pullback. It's stuck around 4,000. It's consolidating around 4,000, which it seems to be, they're sticking to it like flies stick to fly paper, 4,000. So, but it's going up because the ratio of calls to puts at 4,000, with the contracts ending November 24th, it's about 2-to-1. The calls outnumber the puts by about 2-to-1. So that means the market thinks that its price is going up. It might be consolidating at 4,000, but they think it's going to go higher, not lower. So you've got three things tilting us towards maybe overdoing it and increasing that money supply. Now it's growing at it's growing at 4.5% per year. Hanke's golden growth rate, a rate consistent with hitting a 2% inflation target in the United States, is 6%. So the question is, well, will the quantitative tightening being eliminated and the supplemental liquidity ratio being done away with at commercial banks, and this overhang of this huge deficit, with the White House putting lots of pressure to loosen up monetary policy, will the Fed end up overdoing it and getting that money supply growing up at a rate significantly higher than 6% per year? If that happens, then we're off to the races again. And the next thing that will happen, that will support asset price increases. And then we'll have the inflation problem facing us. So we don't know exactly, but I'm just saying the deck's being stacked up in such a way that maybe instead of being on this glide path down with contraction of the money supply, slow money supply growth, inflation going down, 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 we might be looking at a pivot here. I think that the Supreme Court, if logic was governing things, the tariffs would be deemed illegal because they certainly don't fall under this emergency legislation of 1977. The trade deficit is not an emergency. We have had the trade deficit since 1975 every year in the United States. And that is caused not by some foreign element. That the Emergency Act is if some foreigner is doing something that affects the United States. That's when you invoke or can use the emergency. And that emergency is just not there because the deficits are created, trade deficits are created by Americans spending more than they produces a trade deficit. So the origin of the trade deficit is America. It isn't some foreigner. And this 1977 law is targeted on things that foreigners do. The emergency can only arise if a foreigner does something to America, and then you can impose a law. Now, as it turns out, by the way, the emergency law is a bad law. All these emergencies are, because we've actually had this emergency law, the International Emergency Economic Powers Act is what it's called. It's been invoked 69 times since it was introduced in 1977, but 39 of those emergencies still exist. They don't go away. 57% of the so-called emergencies we've had in the United States, they stay and have a life that is a lot longer than any emergency. So the whole thing is complete nonsense, and I don't think that the Supreme Court, they're going to have to really twist not to indicate that this is illegal. So what happens then? Well, Trump will try to impose these tariffs using other laws, and it will be extremely messy. So there'll be a tremendous amount of uncertainty if they say at the Supreme Court that it's illegal, which I think logically should. I don't know whether they will, obviously, but if they say it's illegal, then things will really get messy, because Trump will try to continue to do what he's doing, and he'll be able to find other laws that he can use to impose the tariffs he's already imposed. But it will be very uncertain and unclear what's going on for many months.
Gold and silver markets remain strong as investors seek safety amid economic uncertainty and weakening fiat currencies. Despite recent pullbacks, both metals have held near record highs, signaling resilience and growing long-term confidence. Central bank purchases, rising inflation, and concerns about global debt continue to drive demand. Silver, in particular, is showing renewed strength after cooling off from overbought conditions, suggesting that another rally could be on the horizon. In the next part of the video, financial analyst Bill Holter shares his insights on the current state of the precious metals market. He explains how recent paper sell-offs failed to push prices down as they had in the past, highlighting strong physical demand and a shift in market dynamics. Holter discusses how gold and silver are consolidating after major gains, setting the stage for what could be the next leg higher in this ongoing bull market. Let's return to the video.
We're back to the high levels, not quite on gold, but yes, on silver. But neither silver nor gold are as overbought as they were 3 weeks ago. So they worked off some of the overbought. The paper sales did not work in cash. I mean, yes, they got a short-term pullback, but it didn't work like it had in the past, where you get a smash and, it's another month, 2 months, 3 months before those numbers are revisited. I mean, this was amazing that the metals have, they pulled back basically to where they should have on charts, relieved the overbought, and here we are again, not as overbought as we were before. And in silver, well, in both, in gold and silver, you're starting to see some global price insensitivity. They don't care about the price. They want the ounces. The paper markets were the tail on the dog, but the tail constantly wagged the dog because they would overwhelm the physical markets with paper. The problem now is they've done it for so long and to such a grand extent that now there's a question whether these paper contracts are going to be able to deliver. And the answer I think you're going to find in the next month to 3 months, we're going to find out that no, the paper markets are not a substitute for real physical because they have to deliver real physical that does not exist to be delivered. The market is, I mean, the bottom line is all of the futures, options, paper products, etc., they're all based off of the physical metal in the first place anyway. That's why they're called derivatives. They're derivatives of the actual product. I mean, if gold were to go, if gold doesn't deliver, the system dies anyway. But if gold doesn't deliver, it's not a direct effect on production, if you will. Silver is used in so many different applications, whether it be industrial, technological, medicinal. I just did an interview and was talking about every time they shoot a Tomahawk missile, there goes a monster box. You can't make a Tomahawk missile without roughly 500 ounces of silver. So silver will have profound ramifications to the real world, to the real economy. Now, that said, if silver goes failure to deliver or gold goes failure to deliver, you're stuck in the casino because the casino will close. And when the casino closes, and we've talked about this, for the last, year and a half, maybe even 2 years, we've talked about the great taking. Once the casino closes and banks and brokers and insurance companies start going belly up, they're going to take your capital with them. And that's why it's so important to get your capital out of the system into something, gold and silver, that cannot bankrupt, and in a place where it can't be taken from you. I mean, the payback in gold is obviously greater than the payback in silver. So gold is going to be the target. And I would say either generic rounds or bars are going to be the easiest to, they'll be the easiest to counterfeit. I mean, it's more difficult to counterfeit an elaborate coin, but yeah, they can be counterfeited. And that brings me to a topic I want to talk about. In silver, I've been an advocate of junk silver as the best form to own in the United States. Roughly 14 dimes equals an ounce. So you've got 14 transactions. It's the smallest denomination. It's U.S. Mint lineage. It really can't be counterfeited because it's got to show scruffiness. I mean, these were in people's pockets. Well, I mean, just look at spot. And if today in this market right now, if you're looking at a high premium, anything over, I don't know, even 5 or 6% for gold eagles, anything over that, you're getting ripped off because the premiums don't exist today. Most products can be purchased within 5% of spot. We have interest rates still at basically generational lows. I mean, we're not where we were 3 or 4 years ago. We're not at 0% rates, but rates are extremely low. There's no risk premium in interest rates at all. So brokers and banks, they understand that the likelihood long-term, 5 years, 10 years, longer than that, the likelihood is that rates are going to go higher, not lower. And they also understand that there's going to have to be another mass printing, whether they call it QE or not, it doesn't matter. But there's going to be another global mass printing. And the problem with that is that debases the currencies, and that lowers the value of the unbacked currencies. If the values are lower, then you got to give more of dollars or euros or yen or whatever for that same ounce of gold or the same ounce of silver. So I think they're looking at it pragmatically and saying, yeah, the day of buying and holding bonds is over, and that's why they're recommending half of that bond position be liquidated and put into gold. The only problem with that is if everybody did that, you'd have gold at probably, who knows, $2 million an ounce. Just pick a number, but it's going to be super, super high.
Gold and silver continue to prove their strength as the world's financial landscape grows more uncertain. With inflation pressures, global debt concerns, and central banks buying record amounts of gold, the stage is set for further upside in precious metals. Both experts agree that while short-term corrections are normal, the long-term direction remains bullish. Investors who stay patient during these consolidation phases may be positioning themselves for major gains ahead. As Steve Hanke points to gold's potential peak near $6,000 and Bill Holter highlights the market's resilience against paper sell-offs, it's clear that the fundamentals for gold and silver remain strong. The message is simple: trust the trend, understand the cycles, and stay informed. If you believe in the future of real money, now's the time to pay attention. Don't forget to like, subscribe, and stay tuned for more insights from the channel.